In today's video, we would be discussing about investing decisions as a part of our series on financial management. But at first, let's try and understand what is meant by an investment. We all are quite familiar with this term investment. When we buy shares of a company, when we buy mutual funds, when we buy policy, when we buy a property, or when we buy a flat, we usually refer to that as an investment. But what is an investment? An investment is simply allocation of funds with an expectation to generate profit in the future or with the expectation that the asset would appreciate in terms of its value. So here we are setting aside some money whereby which we could either earn an additional cash flow in the future or with the expectation that the value of the asset would increase whereby through which we could generate a profit. Similarly, when we talk about investment from the point of view of a business, it either simply means starting a new business, expanding the existing business, or going ahead and acquiring a new business for the advantage of competitiveness, whereby through which the company could earn more profit. Usually, businesses would carry out investments with the expectation that the investment should fetch them capital appreciation, or it would help them in additional income generation, or it would help them with their wealth preservation, diversification, or through risk management. Whenever we talk about investments, you have to understand multiple factors needs to be taken into consideration before which that decision can be finalized. Now, whenever a business has to take up investment decisions, there are two important aspects which are involved. First is the aspect of risk, the second is the aspect of return. Let's try and understand this a little bit more in detail. What is return? Return simply refers to what is the additional amount of gain or profit the business would be generating by taking up that investment decision. Risk refers to the uncertainty or the potential of loss of that possible investment decision that has been taken up. Now, there's a positive relationship between risk and return. This is often referred to as risk return trade off. So, whereby this simply means that if an investment is expected to fetch you more return, there would be more or there would be a greater degree of risk which would be associated with it. So businesses and investors both they equally need to understand what is the degree of risk that they are willing to take. This is referred to as their risk appetite or risk tolerance. Understand what is the objectivity behind taking up that investment decision, whereby with which they would be able to easily understand is that investment decision favorable for them. If we go ahead and plot the values of risk and return on a graph, the relationship would look something like this. This is the positive relationship between risk and return, which is referred to as the risk return trade off. Let's talk about investment decisions. What is an investment decision? Investment decision is simply the process through which the business or the investor would understand how much of funds can be allocated, where it can be allocated, and by doing so, how much of income can be achieved in the future, and will that help in fulfilling the objectives or the goals of the investor and the business. Now, we have to understand this is a very vigorous process through which the different opportunities needs to be identified, different factors needs to be taken into consideration, whereby with which the decision could be finalized. So it simply means the business would have to undergo the process of understanding the risk return trade off which is associated with the decisions that are taken. Now, this is a strategic level decision that needs the involvement of the top level management. The top level management would examine the market opportunities. They would understand what are the risks which are associated with the decisions that they are taking, and eventually they would come to a conclusion. Now, implementing the investment decision is just not enough. This needs to be constantly reviewed and monitored to understand whether the investment decision is fetching the management the intended or the desired results. Now, the investment decisions, there are some important information which has been needed or required. Ezra Solomon, the famous US economist and the professor at Stanford University, has proposed there are three major sets of data that is needed. The first is to estimate how much of capital that is needed and what are the future possible earnings the business is likely to generate through this. The next set of information that is needed is what are the sources and how much of capital is available with the business. And finally, the business needs to follow a set of standards in terms of selecting the project and implementing it. So this would include due diligence processes, approval processes, following up on the implementation strategies, etc. So these are some of the important information that is needed as a part of the implementation of the investment decision. Let's try and understand what are the kind of expenses that are incurred by the business. When you look at the expenses that are incurred by the business, it can be broadly classified into two. We have what is called as capital expenditure, or which is called as capex. Then we have revenue expenditures, sometimes which is referred to as operational expenditures. Let's try and see how are these two different from each other. Capital expenditures are usually expenditures which go beyond one accounting period. The decision to go ahead with a capital expenditure sometimes extends beyond one accounting period of the business. The amount of money that would be involved in capital expenditures are really huge in terms of the amount. And these decisions would usually have long-term impact on your business. Here's the deal. You decide to buy a house and you decide to take it on a 20 years housing loan. Now, that decision definitely has an impact on your life for the next 20 years. Each month, you need to ensure that you have the adequate amount of money to pay off that EMI. So, capital expenditures, the amount of money which is involved is really huge, and it has a long-term impact on the decision of the company. The next category of expenses are referred to as revenue expenditures. Operational expenditures, in short, is referred to as OPEX. Usually, OPEX does not span beyond one accounting period. The amount of money which is involved is less. And finally, it does not have a long-term impact on your business. Here's the deal. The decision to buy milk for yourself. Which brand of milk to buy? It does not really have a huge consequence. The amount of money which is involved is less, and it does not really have a huge impact on your life. So, in short, when we compare the differences between capital expenditures and revenue expenditures, we can see that capital expenditure has a huge impact on the earning capacity of your firm, whereas operational expenditure helps you to maintain your earning capacity. So that would be one fundamental difference between the the capital expenditure and the revenue expenditure. When we move forward from here and when we talk about capital expenditures, we would see there are 5 major types of capital expenditures. The 5 types of capital expenditures are expansion, diversification, modernization, research and development, miscellaneous. Now let's discuss each of these in detail. The first capital expenditure that we'll be talking about is expansion. What is expansion? When your firm is looking at investing money to expand its existing capacity. Until now, you're producing 100 units, you wish to scale and produce 1,000 units. That would be an example of expansion strategy. When a company goes in for capital expenditure decisions that are associated with expansion, they probably need to identify new geographical locations, set up new plants over there, or they may need to scale up the existing facilities. Let's say in your city, you already have a production unit, and the production unit at present, it is equipped to produce 10 units. You need to scale that up to produce 1,000 units. Okay, so expansion decisions, probably you need to identify new locations or you need to scale up the existing location. Either ways, as a part of your expansion strategy, the business would be looking forward in increasing the overall capacity of the firm. We can think of an example for this. The famous company ID Fresh, which is well known for its ready to cook uh, product lines. At present, they have production facilities which are located in Bangalore, Hyderabad, Mumbai, and Dubai. In the coming years, the company is looking forward in setting up plants in Delhi, Kolkata, and New Jersey. And in the long run, they're also looking forward in expanding internationally by setting up new plants in Singapore and UK. The company is very vigorously expanding its facilities so that it could achieve its target of 700 crores in terms of its revenue. So, to achieve this, the company constantly needs to scale up its facility by identifying new locations. The next type of capital expenditure the business incurs is called as diversification. As a part of diversification strategy or diversification decision, the business expands its existing uh, production capabilities or gets into new lines of business. So the company would venture into new sectors, and in these new sectors, the company would think of introducing new product lines. Let's say until now, you were in telecom. From telecom, you decide to get into real estate. That would be an example of diversification. The best example for diversification that I could give is that of Reliance Industries. Reliance Industries started off as a refining firm, expanded into petrochemicals, expanded into retail, got into digital services, got into media and entertainment. So, through following this strategy, the business managed to diversify and generate new revenue streams. The next type of capital expenditure that a firm would incur is referred to as modernization. As a part of modernization, the firm would think of upgrading its existing production process. So you were following a certain line of production technology or production technique, you decide to give away that and get into something totally new. So as a part of this, what the business would do is they would have to replace the existing infrastructure which is available. The best example is what we're witnessing in telecom. Telecom, we all have seen the 4G technology which came into picture. Eventually, that has been replaced by 5G. Another example that I could give you for modernization capex is that from the Indian Railway. Indian Railway very vigorously is spending money to modernize its infrastructure, trains, as well as rail stations. So all this would be examples of modernization capital expenditures, which is incurred by the Railway Ministry to improve on its services. The next type of capital expenditure would be for research and development. As a part of research and development, what would happen is the firm would have to improve the existing products and services, or they would have to look out and research for breakthrough technology. The best would be what we would be seeing in the automobile industry. We would see that specific product lines, there would be constant facelifts and upgradations that the companies and these models will be undergoing. In the same automobile industry, we are seeing that the firms are very vigorously expanding and investing into EVs. The example for research and development that I could give is the case of IBM, which spent around $6.5 billion in 2022, whereby with which the company was able to file for 8,513 patents. So by investing very vigorously into research and development, the company is able to focus on innovative product lines and services. The last category of capital expenditures would be miscellaneous expenses. So anything which does not fall into other four would automatically be termed as miscellaneous expenses. So best example would be that of State Bank of India, which has established a State Bank Staff Training Center at Jagur in Bangalore, which has got state-of-art training facilities and emulations of a fully functional branch, which will help in training up their employees. So these are some of the examples of capital expenditures.